on the 1st of February.
Okay, so those are all the domestic cues, and now let's invite our global experts to parse the FOMC minutes. Joining us is Richard Harris, the Chief Executive at Port Shelter Investment Management, and Robert Sockin, the Global Economist at Citi. Gentlemen, thank you very much for joining us. Robert, thank you for staying up for us. Let me start with you, Richard. How would you parse what the Fed had to say?
Well, I think that we're in a situation at the moment where the Fed actually wants to be a friend to everybody. They're not really coming up with anything definite. And I think analysts really have to take their own counsel from this and look at the evidence. You know, the Fed has blown hot and cold. We are seeing inflation coming down. But the bottom line is that if the Fed increase, they are likely to bring on a recession. If they cut rates for any reason, they are likely to have inflation running out of control. And if they keep things as they are, or let's assume we're in the Goldilocks position now, we still have inflation and interest rates that are going to remain stubbornly well above what we've seen over the last 10 years. So I think the impact on Main Street this year is going to be quite difficult. So the Fed, I think, is going to blow hot and cold. It's going to be very difficult to get any signs, real signs from them. And I think analysts just have to look at the evidence.
Robert, I was particularly puzzled by that statement on, the perception of the market. They explained that, the Fed can work only if the policy works through the market, and therefore this pricing in of cuts appears to disturb them. How should we understand it? Therefore, will they be even more hawkish than what the dot chart told us in December?
Thanks so much for having me. That's a great question. And I think what the Fed was trying to accomplish there is that they're clearly becoming uncomfortable with the level of market pricing that they've seen in recent weeks and months of underestimating how far the Fed is willing to go to bring inflation back down to target, underestimating how long they're willing to hold their policy rate once they stop hiking in the cycle, and overestimating their desire to cut quickly at any signs that inflation is showing signs of decelerating. What the Fed really wants to emphasize is that even though they have a dual mandate of employment and inflation, getting inflation back to target is job number one, and that they're willing to bear a growth cost to bring inflation down. And if that includes a recession, I think that's what's likely to happen. And that they want financial conditions to tighten appropriately, because if they don't, it makes their job even harder because, as you noted earlier, monetary policy plays through the system by first tightening financial conditions, then playing through into the real economy. If the market doesn't believe that they're committed to bringing policy rates above 5%, if markets don't believe that the risks are to the upside, that policy rate has to go even higher, and if markets don't believe that they're going to hold that rate for a material period of time next year, that makes their job a lot harder, and that goes against their fight against inflation.
Okay, so what's the strategy, Richard, now with markets like India? Because there's definitely a slowdown in growth. The projections here as well are about 4.5% GDP growth for the second half of the year. There's earnings slowdown that people are looking at as well. Do you raise cash levels? Do you move to asset classes like gold? Because gold has been doing very well too. What's the approach?
Well, it's always difficult because markets move in sudden jumps. From what we're seeing, I mean, both of us seem to agree that the Fed is probably not going to stay here. And when markets realize that, I think that they're going to have a big fall. Markets move in sudden jumps. However, we analysts don't like to make those sudden jumps as well, because we could be completely wrong. However, I think it's very important to be cautious. I think this is a year when you can't run, you can't hide. We don't know if there's going to be a big fall, when there's going to be a big fall, as markets take on these more negative issues that have sort of disappeared over the last quarter. So I think it is quite difficult. But I think investors do need to be cautious. They do need to be aware that if we do see inflation, some companies are going to be hit, and other companies like consumer staples will probably be able to keep ticking their prices up. I still think the tech sector has a lot going for it, because if people are looking to cut costs, they're probably going to invest into tech. Yes, we've seen a big fall, and that may still continue a little bit. But I think that if you're looking longer term and you want to look over the valley, then tech is one sector you shouldn't ignore.
Okay, all right. Hi, Richard. Morning. What about the toss-up between India and China? In the past, you've said you're not really convinced. Data points that are coming out there, they're not convincing enough for you to look at China. But what's your sense now at these valuations, post the underperformance that China has seen? Will you give it a look?
Yeah, well, that's a good question, because you're right. I think last time we spoke, China hadn't really come out of its COVID lockdown. Now they've gone from one end to the other almost. And I think that if you're looking tactically, then I think China and maybe even Hong Kong as an option on China actually look very good on a tactical basis. And if you look at what happened to the US and Europe when they came out of lockdown, we had a huge amount of revenge spending. So I think we'll see growth without the Chinese authorities even trying very hard. But that will be tactical. And that will probably outperform other markets, I would say, for the next quarter, maybe the next 2 quarters. But after that, China still has to figure that whatever the world does, that's going to happen to China. China cannot outgrow the world anymore. It's just too big for that. And I think that views of people thinking that Chinese growth are going to go back to where they were previously, I think they're way out of line. So the bottom line is that, yes, China looks very interesting tactically, probably one of the best, brightest areas in the investment spectrum you can see at the moment. But sooner or later, they'll come into line. The revenge buying will slow down, and China will come back into line with other markets.
Okay. Yeah, I don't think I've seen a GDP forecast above 5% even for China. So I guess people are not penciling in too much there, but clearly attractive prices. Robert, what should we make of US bond yields and the currency? Do you think the dollar index doesn't go up anymore? It's headed down, and therefore, can EM currencies like India at least rest that further depreciation is not in order?
I think starting on the yield side, I think what we saw last year was that the yield curve got a bit too inverted if you look at the 2s, 10s yields, particularly on the 10 side. I think the 10s got a bit too low towards the end of last year. You've seen some of that reverse in recent weeks. And we put out a piece where we think the 2s, 10s inversion will average about 60 basis points over the next several months, and then start to steepen in earnest once the Fed pauses its policy path. So I think, from here, you're probably looking at, similar rates going forward, potentially maybe a little more upside in the 10-year yield in the short term. But that's kind of how we see the spread of the curve over the next several months. On the dollar side, we think you're probably near points where the dollar is not going to strengthen much further from here. You're getting closer towards the likely end of the Fed hiking cycle. We see another 100 basis points from here. And so we think the dollar is going to stay strong, probably around current levels, maybe a bit stronger in Q1, but then start to depreciate, particularly against other major developed currencies over coming quarters. So I would say the story for the dollar is that we are probably behind peak levels, and that by the end of next year, the currency will likely be a fair amount weaker, and that will allow for adjustment of other currencies, major DM and also major EM currencies to appreciate relative to the dollar.
Okay, one final question then, and very short one at that, Richard. Do you see a major global correction coming, especially in markets like India or emerging markets? Or is this just a painful time correction that we will have to endure?
Well, I think the concern that we have to look at this year is last year was a horrendous one. If you look at the numbers on the financial markets, on Wall Street, if you like, we had both equities and bonds going down in a way we have never seen in decades, maybe even in 100 years. However, I think that Wall Street, the concerns are going to move into Main Street. When they move into Main Street, more unemployment because people are looking at cutting costs. reducing earnings because people are looking at cutting costs. I don't see really a lot of outcome for growth, and I suspect that we may see some more stress on Main Street this year rather than Wall Street. And of course, that will have an impact on the financial markets.
Okay. Yes, it will. We just want to know how much should we buckle our seats for. Thank you very much, Richard Harris and Robert Sockin, Robert Sockin for waiting up for us, and Richard Harris for sparing time with us. Thank you very much.
Thank you.
Thank you.
Okay, so as you can see, everyone's asking us to put on our seatbelts. It looks like it's going to be a rocky ride. But let's see if we can get more advantage because of the crude price fall. Quick break now, and then our team will be with us to list the top 10 stocks.
PS3.